The market will always tell you its intention if you know how to listen. This principle transformed my trading from inconsistent guesswork to a systematic approach that consistently achieves big RRs trading the market. Today, I'm showing you 5 trades where I correctly read the market's intention and positioned myself in the correct location at the right time. You will see how I identify the RIMC trader model, range, initiation, mitigation, continuation, and how I use each phase to maximize profits in my session. The RIMC model allows us to read the correct market intention. What if I told you that the market tells you exactly what it plans to do next? Most traders spend years looking for the perfect indicator or strategy, when in reality, the market is already communicating its intentions through price structure. Imagine you're watching your USD on a 1 minute time frame during London session, and first you notice the range phase where price is moving sideways, where we know the people who control the market stack their orders. We know this is happening in real time because price is contained between previous highs and previous lows in the market. Think of this as the market gathering energy as price starts to stack like a coil spring. When we see that over time, price breaks out of this range, here, we enter the initiation phase. This is where the market shows its intention, moving in one direction. This isn't random. This is a clear signal of their intentions for higher prices. Most unsuccessful traders see this happen and end up chasing the move when it's already too late. Following initiation, the market typically pulls back in what we call the mitigation phase. This retracement often confuses traders, causing them to think that the market's reversed. But the logic of the RIMC model tells us that the pullback is the perfect entry opportunity, a chance to join the move at a better price with reduced risk. Finally, we have the continuation phase where price moves in that direction that was shown in the phase of initiation. This is where the skilled trader's patience pays off as market follows through on its intention, putting our trade execution into profit. The beauty of the RIMC model lies in the ability to create predictable entry points with minimal risk. For example, during a strong initiation phase to the downside, you can look for specific sell low conditions where price is unlikely to return to premium levels. By waiting for these conditions, you're not guessing, you're trading the market's clear intention in the right direction. These are the repeatable observations in our sessions, building our systematic approach. Each of the 5 winning trades I'm about to share demonstrates how RIMC adapts to various market conditions while maintaining this core principle, understanding market structure and its intention before placing a trade. I didn't select these trades randomly. Each one was chosen based on a specific criteria: high profit potential, technical precision that demonstrates a textbook execution, adaptability to changing market conditions, and perfect risk control. Together, they provide a masterclass on how to apply the RIMC model across different trading scenarios. The results across these 5 trades can offer a substantial amount, far beyond what most traders achieve in months of trading. Onto the 1 minute chart, we can start to think about the execution of these positions that allow us to maximize our profit potential using the RIMC model. So allow me to start by first going up to the higher timeframes, because yes, we do trade the lower time frame. Yes, my executions are on the 1 minute chart, but the way I trade as a professional trader is to understand the environment that I'm in. So this is Euro USD. We're now on a 4-hour chart, and we can see here that this line is a representation of a new week, and that week is showing us that we are in the location of a previous range, and we can see that range shown here. And what that's doing for me is allowing me to realize that this location is likely to move lower based on a previous range in the market. So notice how we're utilizing our concepts fractally. We're not changing our observations for the higher time frame. We're actually using the exact same observations as a lower time frame because we know that our concepts are based on fractal models, and we can essentially understand any time frame that we're looking at. So yes, this is a 4-hour chart. It's great to be able to see the location for the session. We can see that we came from a low here in the market. We can also see that we have a previous high over here, A to B, and price is now pulled back into this location. So perhaps we can see a reaction for lower prices. And as we get into the lower time frame, that is the narrative that I'm trading with. So what can we see on a 1 minute chart? We can see that price has moved above a previous high here and reacted in the bearish direction. We can also see that price here is starting to slow down. We see that we did break above the high, but we had quite a fast rejection in the opposite direction. And this is the identification of initiation in the market. Some people identify ranges more and some people identify initiations more, but we can utilize all of our phases of understanding to find the direction of the market. So here we can see that price did end up ranging here. Let's just put a box on, make that a bit thicker so you guys can see. So we can see that price did end up ranging and initiating in the bearish direction. And this is how I'm finding the direction in the market. So my assumption is that price wants to move lower based on the intention in the market. If you notice here, price is not pulling back to the edge and we're continuing to move lower. This is great observations because we're seeing that the intention is following through, and likely the next observation is going to be in and around that 50% location for a possible short following that intention in the market. So we are on a 1 minute chart here. We can see that price has come back into a previous range. Let's just change the color. It's a bit easier to see. So we can see that we have come back into a previous range here, and that previous range can be identified. If I just take the session color off here, we can see that there's a previous high, previous low in the market. And we can see that was part of our initiation down. Price then slowed down. We can see it slowed down because we've taken the previous low. Wrong low. We've taken the previous low and then we pulled back into our previous high. And what have we seen? We've seen price close inside of the range. So we can see price is slowing down over time and then price moves below, confirming the direction of the market where we can start to build a narrative to play the correct direction. Now, this is exactly what my trade was based on. So we can see here a range in the market and my trade is positioned in and around that location. So we can see here with a entry here and a stop above a previous high, we have around a 3.2 pip stop. And what we're essentially saying here is in the market, we're going to see price move in the opposite intention. And that opposite intention is equal to seeing the market move up, right? This has been a bullish move into higher prices. Now we can see price is pulling back and we can see that the location overall is 50%. And this is the identification of looking for continuation in the market. And it's this location that I'll be looking for price to move in the bearish direction based on the previous intention shown. Here we can see it's bearish and the fact that it came from a range in market, right? A market that is slowing itself down and then moving in the opposite intention, right? So it's in these locations that I will start to look for continuation in the market. And that's exactly what I've done here, following our range initiation mitigation model and then looking for price to move in the bearish direction. So of course, the continuation part of the move, you can see that this is the mitigation of our previous range in the market following intention shown. And now we will be looking for the continuation into lower prices. And what that means is that we're looking for previous lows to be taken out. So you can see we've got stacked lows here, we've got low here, and that's the observation. So let's play this forward. We can start to see price taking previous lows and moving in that bearish direction. So this is a great observation to be in the correct direction. In our session, we can clearly see now that we have got the right direction in the market. And if I start to zoom out here, we can see that there's also other setups that are presented to us based on high probability to move in the opposite direction. Now, using a fixed process in terms of TP, because we've discussed the entry, we've discussed where the stop loss goes above the previous high. When we think about the take profit, we should be thinking about, okay, what is our set process? For me, it is a 1 to 10. I look at gaining the most out of the move possible. So for me, I've derived with my data after trading 4 years, this process that around 10R is a very good place to be over time. Of course, some might look at this as extreme, but for me, I have the data that backs this up. So we can see price then is pulling back, and this is quite a long, let's just let this play out while I'll talk, but this is quite a long TP. So you can see here, looking for that continuation in price, and this is the reality of trading. Now, what I focus on is being in the correct direction, following the correct intention, and that's for the day, that's for my session. I'm not trying to do it forever, but what I am trying to do is each day show myself that I can trade in the correct direction using repeatable processes. Now, when it comes to the take profit, for price to essentially allow me to exit the market, it needs to move a distance of around 40 pips in my direction. Now, for price to move 40 pips in the markets, let's stop it here, we can move 40 pips in many ways, right? We can move 30 to 40 pips like this. We can move 30 to 40 pips like this. We understand that there's two phases of the market. There's the market that is moving over time, and then there's the market that is slowing down. So that observation here is clearly market slowing down, but look at what I'm doing here. I'm trading from, remember, the higher time frame narrative, looking for lower prices, seeing a continuation below previous lows, seeing a continuation of that intention being shown, and also seeing previous highs be sustained. So while I don't know what's going to happen next, because we are moving into different structures, different points of mitigations where we can see reactions in price, essentially what I'm trying to do is just position myself in the correct direction. And we can see here, typically my TP is getting hit pretty quickly. On this occasion, it took quite long, right? So that's one observation. We can see here that the patience of the trader is really key. To build discipline in understanding our process allows us to be patient and wait. Now, someone else could have come along and said, I'll take 5R. Perfect, right? That is a fixed process. And if that's what the trader chooses based on their understanding, then I think this is a great place to start, right? Because this will build the discipline to, over time, start to see that you do get the correct direction in the market, start to see that London session can create direction for the day, and be confident to hold your trades, right? If we just play this slightly a bit more forward, we can see that prices continues to take lows here, continues to offer us even more RR in the markets. Don't be afraid. When we have the correct direction in the market, this can be very, very big for us, because that potential return from holding some lots into that direction, we can start to yield some very big returns off of one trade. So be confident to see the direction and play it. By mastering the RIMC model, you transform your trading from an unpredictable guessing game into a systematic approach with calculated results. Instead of bouncing around that break-even stage at mercy to the market, you can become a skilled trader who can identify high probability trading opportunities based on repeatable market structures. You will no longer be saying, will this trade work out? But instead, is this the right phase to execute? Stay with me, guys. Remember, we're focusing on identifying the RIMC model, identifying the best trade locations. We're looking to maximize our profits in the session. We're not talking about 5R, 6R, 7R trades. We're talking about 10% reward trades. And this is what we should be aiming for. We're maintaining low risk. We're not having to risk 2, 3, 4% of our account to make 10%. We can stick at 1% and even go down to 0.5% and still end up with high RR returns. This is what's going to allow you to pass those accounts fairly quickly, confidently, making sure you're moving in the right direction. So what can we see here? We can see we have a phase of the market moving sideways. So we can identify a sideways market quite easily based on how price is delivering. And what do we see? We see price then initiates out of that range and price moves to the upside in the bullish direction, where we can start to perhaps see higher prices. But let's just quickly zoom out here. And where are we located? Well, quite quickly, we can see that this is relatively new high prices. So to buy up here, for me, would be low probability. And likely what I'm going to be looking for, perhaps, is either a point of mitigation based on our mitigation process, which means that this would be a continuation in the market, perhaps to take a previous low Or we can just utilize the 1 minute time frame here and see that price is immediately moving back in the opposite direction. So the same way we had that direction shown bullish, we also have that initiation shown bearish. We can see here that over time, let's get the right color on. We can see that over time, price is continuing to the downside. You can see here, price is not pulling back here, and we're mitigating and continuing to the downside. Now, this is where we can see that another phase of range here overall. Let's just take the lower time frame one, change that to a range just to stretch this out. We can see here that we also have a range in the market, and then we're shown another initiation in price. Now we can see that this is moving back into, our previous range of observation. So we can clearly see that this location perhaps might offer some sort of mitigation in the market based on the volume created. But because we understand that we are high in price, perhaps we're not looking for higher prices. What we're doing on a lower time frame is actually following range initiation. And what does this do? This allows us to have a direction in the market. And that's exactly what I'm playing here, that direction. We can see that there's a higher time frame range that's created here that we initiate out of, and price is then pulling back into that range. So that was my observation. I'm just going to zoom out here before I put the entry on so you can see where we're located, right? So we're located fairly high in price. So for me, selling here is very much playing the reversal, anticipating, knowing that in my session, we can see reversals, and then using the 1 minute observation, using price structure to observe how the market is moving, what intention that follows, and then trying to play the correct direction. This is how we can improve in price over time, utilizing repeatable processes. We can see here price pulling back into a previous mitigation, takes the previous low that was shown in the market, and that's exactly where we'll look for a continuation trade. If I draw the previous high to previous low, you can see that this trade was taken in and around 50%, looking to play the continuation direction. Again, these phases, let's just go over this one more time. These phases in the market are so important because when we know that market's slowing down, we know that the next phase is going to be initiation. So if I enter in this phase of the market, my anticipation is the next phase is going to be initiation. So notice how I've gotten in the trade, whether we see this in the moment or not, but this in hindsight is 100% a range. So I've entered my position inside of a range in market. And then what happens next? Price starts to move in the bearish direction, right? And what we're looking for it to do is take out previous lows. So we have a low here that got taken. We have a low here that got taken, and we have a low here that got taken. Now these will all be observed because essentially what price is going to do if it is bearish, it's going to aim for previous lows. So in our session, we definitely make ourselves aware of that observation. And we can also see then our next previous low is down here. Perhaps we can look at this as some sort of swing target in terms of price creating higher prices and then moving in opposite direction. If that intention is in the market for lower prices, we know that these people control the markets. We know that they enter with intention, and what we're looking to do is follow their intentions. This is how we can identify it, and we'll be looking for a price to move then in that bearish direction. You can see a price coming straight into that low, absolutely tagging it, and we're able to see that we're getting a TP here based on a 5 pip stop and a 10R reward. Ample move here to be a part of. Let's just quickly zoom into this because for the skilled trader, for the trader that understands what they're doing, let's just remove this on now. We can understand what we're looking at. So for the trader that can observe the range, what they start to do is utilize that process as price is moving. So what do we see here? We see price ranging and market moving away and moving back into it. And once again, using that location to initiate the next phase in the market. We also see price ranging here over time. Notice that slow delivery. And then as we get that range, price then initiates again out of that range in the bearish direction. And we continue to play ranges here, right? We continue to get ranges and we can continue to observe those locations. Now, these aren't all good trades. Remember, I'm showing you how to identify the best locations, the best setups, so you can maximize your return. These trades down here, I don't recommend, especially for the beginner trader. I recommend trading high in price and not trading low in price. This is the type of delivery that our traders know how to avoid. So just keep that in mind. Remember, we're building discipline, we're building understanding, and we want to maintain low risk. For the trader who is a part of low probability conditions, remember that because we do aim for higher RR, you can afford to lose. So when the trader does lose and they do observe their errors or their locations, what they're able to do then is position themselves better in the future without feeling emotional about losing. Right, very, very important. Essentially what they're likely doing is just going into drawdown of their profits, and maintaining that, managing that as a trader is exactly what we have to learn in the moment. We can't just read a book and know exactly what we need to do. We need to be in the moment and then address that accordingly. On to trade number 3, where we can see price inside of our session running a previous high. Right, that high gets run and we'll start to see his intention shown in the opposite direction. If you notice that, this is kind of a repeatable process that we're looking for, but there's also more in the market, right? People love to just look at liquidity and be biased based on liquidity high, liquidity low. But we also need to understand that we need to trade with direction understanding, and when those people who direct the market step back into the market. So here we can see over Asia session, this isn't Asia, sorry, over New York session, we did see intention in the market. And if I just draw a higher time frame range on here, you can see that market went from a sideways market overall into an initiation market. Now remember that we're utilizing our process across multiple time frames. This is a fractal process where we can identify the people who control the markets. Right? We can even start to refine our ranges, becoming understood that this is where those orders are being placed, and then we get that initiation in price. So we can clearly see stacking of orders in the middle of price and then price moving in one direction. So today, on this price leaf that we can observe, we can see that overall price is sideways. So although we can see direction in the market, we can also see that over time, this range that I showed is also represented on a higher time frame. So you can think of this as a range within a range. But what we can clearly see here is that this is a market in a sideways range. And the location of our session specifically right now is very much 50%. We're actually trading in a poor location. So notice that people want to do the right thing. And a lot of the time when I talk to traders, they don't even know the location of their session. So I know today that this is a low probability day. And on those low probability days where I am trading in the middle of the range, what do I do? Well, of course, after trading this process for 4 years, I have the answer. And this is a great setup to look for in and around the middle of price. And that's for highs and lows to be taken. So we do have a previous high taken here. We know the process that we're not going to buy high in price. If this is where our session started, then we can see that price has moved in that bullish direction. We can see we did range for a period before price initiated, and that did come from a previous low in the markets. So overall, we can see we do have that sideways delivery. How the trader draws their range here is very dependent on their observations, because what time frame are they drawing the range on? But what is true is that these are all ranges inside of a larger range. So actually the observation of these, any of these ranges, no matter what high and lows you're using, is the observation of sideways delivery. In terms of the higher time frame, again, this is quite high prices. So naturally we're looking for the reversal in price for price to move back down into those previous lows. So although the session wasn't, let's say, high probability location for an easy narrative for my session, what I am able to do is utilize, again, the process of understanding and essentially position myself consistently in the best location. So we can see here, again, run above the high. We see them price moving in the opposite direction. So that's definitely an understanding. If I was to look at this in the moment and I was trying to understand, okay, where are my ranges, initiations? Well, I can clearly see that that's a range and then that's initiation. You know, where am I looking here? Well, I'm trying to focus on most recent price. I can see that that's a range and that's an initiation out of the range. You know, definitely price then continuing bullish here, you know, straight up into the previous high. So that's observed. So we definitely have some initiation structure here we can see to the upside. And then, like I said, we get the opposite intention. So we can see we've got initiation. We likely know that if we are looking at this as our new bullish A to B leg, you know, this location to buy is going to be low probability. This is probably what we should avoid, let's say, and not necessarily trade. If we're going to trade, let's trade longs in good locations, and that would be in discounted price. So again, this will be premium based on what's been presented in our session. And now perhaps we're trading price in the opposite direction because of the setup that we've seen here. Now, that's exactly what I was following, that intention in the market. We can see here on a lower time frame, we get some sideways delivery. If you notice that price is moving outside of this range and then moving to the downside, so we get a nice initiation structure. Just like I was able to observe this bullish initiation, I can also observe a range initiation, mitigation, continuation there, and this would be the continuation of that intention shown for lower prices. So upon seeing that, I can also see that price was also slowing down here in between this high and low, and we also got a sideways range here following those lower prices. The thing that's really standing out to me is that previous high, right? Really nice high there to look for safe stop locations and essentially look for that range initiation, mitigation, continuation style trade. And we know, again, we're taking this trade at a previous high in the market. If this is our A, then this would be our B, based on the fact that price has pulled back from a high creation. So this is now the narrative. Let's just play this forward and let's see what comes next. Again, I'm just going to zoom out a bit because we do understand the location to be 50% and we want to see how price delivers here after I put the entry on. See here, so we're going for 6 pip stop and we're looking for, again, a 10 pip reward. Now, if you do look at the date, we do know price was quite volatile around these times. So naturally a larger stop was understood. It was definitely how we was following the market over our sessions, seeing that volatility was increasing and adjusting our stop losses for that fact. And we can see here now price, just before I play it forward, price is showing itself to be bearish. Now, this is so natural because price is high. Remember, if this is our bullish delivery, naturally I'm waiting for price to move back into 50%, move back into discounted prices. As I said earlier, we do kind of have a higher time frame range here as well. So naturally assuming that price is going to want to come and use that volume creation for the next move. So let's just continue to play this forward. Price coming to its range. We see price slowing down this location, also reacting. And we see what we're reacting from. You can see previous range in the market. See price coming down and mitigating and holding that location. What do we notice? We notice that, yes, we are getting those mitigations, but price is not creating new highs in the market. Right, so we do have another sideways range, another clean observation. We do also have initiation here. When we look left, we do come from a sideways range. And we can also see that we're getting continuations of that delivery essentially in terms of lower prices. And this is often what we see when we have the correct direction. Essentially what we're seeing is previous highs be maintained and previous lows be taken, right? That is sustained lower prices. Essentially what we're looking at is a bearish trend in the market. The narrative of mitigation continuation obviously gives us the ability to predict the next move because we know once price ranges, the next phase is going to be initiation. So that's exactly what I'm expecting after this range creation. Remembering that the initiation can also be in the opposite direction, guys. You know, we can be in the right direction, of course. That doesn't mean we're going to TP. Obviously, what we want to see is the extension in that direction. The people who control the market, they're going to extend price in one direction. That's what I'm looking to follow. And we can see here, let's clean this up as price moves. Price is continuing to range. So that mitigation continuing to hold. We see the highs being created here, continuing to be maintained, lows being taken, price taking that previous low in the market. So that's nice because we can see that we definitely found the correct direction in the market. What those people are going to want to do is aim into those swing highs and swing lows created in the market. So a low created in London obviously was taken, and then we can see price over time extend into lower prices. This was a 60 pip TP, so naturally I'd expect someone has to wait for that. I definitely did. And the anticipation essentially was being able to play that right direction over time. Price stretching in that direction. Once again, by New York, we've TP'd here. What can we see? We can see price ranging. We can see price initiating out of the range. We see price pulling back in. Where does price pull back into? A previous range in the market. We can even refine that to the edge, and we can see price moving past previous lows and showing that direction. Same process back into London session. What can we see? We can see that over time prices continued into higher prices. How can we recognize that? We can recognize that by previous lows being created, previous ranges. You can see price range and initiating, create more ranges, moving out the range, again, create more ranges over time, and we see prices essentially slowly moving to the upside. Right, previous lows taken, previous highs taken. We can see prices ranging. We're pulling back into where? Into previous mitigation, and we can see prices reacting for higher prices. So nice to see higher taken. We see the pullback, we see the mitigation, we see the continuation to higher prices. So we can see overall that we are ranging. Definitely see that. And in price, we can see is initiating out of the range. If I zoom out, perhaps that might be easier for you to see. And what we can also see, right, is that bullish delivery from that low is moving into a previous high in the markets. Now, if we zoom out, we can see that we do have a previous range here that was created and prices reacting out of that location. And we did see intention shown from that location, taken at the previous low. We can see here that price, we did actually pull back here, but did pretty much just tap it quite literally. And then we see mitigation, initiation. So price is showing that intention direction over time. Definitely what I see in the market here is direction, and direction shown because we're taking out previous lows. We can see here that if this wasn't for bullish price, then surely that means price is bearish. And what do we notice? That price is pulling back into a previous intention, and we're looking to play that intention to the downside. So again, coming into the session, we can see that the location of the session is moving back into a previous high. And when I do look left, I can see the market starting to slow down here. How can I see it slow down? Because we go from creating high close candles to then pulling back, right? So that pullback is a potential B in the markets. And when I look left, the location of that is relatively in higher prices. So we can identify this as a higher probability location. Notice that this trade is not 50%. 50% would be this location to look for lower prices. And we can see here that price was reacting, but not committing to that continuation location. And what we then see over time is price ranging. And when we know we're in a range, the best locations are going to be those edges. And this is what we can identify here. So again, price slowing down at this location. When we do start to look left, we can see that there is a previous range here that we saw initiation to the downside. We also notice that price didn't pull back. So we know that this is a mitigation location for the future, and that's exactly what we see. So let's mark that range on, then we get that mitigation location, right? Where price now is at a location where we can see previous intention be shown. This is going to be the target, or we're going to see price mitigate and start to move in opposite direction. And this is exactly what I'm looking for. So what do we see? Point of mitigation. I'm looking for lower prices. And because price is moving up quite fast here, I wasn't willing to just press sell with a stop above that high. Definitely could have played that with a nice 3.2 pip stop. That's my aim there. And we could have had a nice TP to the downside. But actually, I was convinced price was going to go higher. And then we saw a reaction. So that reaction was shown and I was reacting to that. And really what I wanted to do here was be bearish. Like I said, this is really what I should be in, but not willing to play that based on how price is delivering. But now I understand price to be slowing down. So we create a high here, we create a low here. Really what I want to do is get in within that sideways range with my stop in a good location that is above the previous high, looking for price to move in the bearish direction. So let's watch how price plays here, because essentially what we should see is that range initiation. Price is slowing down at a previous mitigation, and this is how we can observe how to be a participant in these trades. Remember, we're trading from good locations. We're looking for trades that can maximize our profits, and these high probability locations are a great factor of that. So we can see price come up, we mitigate, and then price starts to initiate in the bearish direction. Quite a quick TP there. You saw it was only a 2.6 pip stop with a stop above the high. Again, we're following this very similar processes. We also see here there was also a trade after within this range here. So quite a few of our traders were either in the mitigation, was either in when price was slowing down, or was either in on the back of this mitigation point here. So a nice observation to see. You saw where I entered, but multiple entries in here that we could be a part of for the mitigation for lower prices. So nice. Once again, a 10-hour trade within the session. It's always nice to hit TP within the session because you can move on with your day without needing to check the charts. Zoom out here, we can see the process of lower prices, and we can watch price as it continues. So the understanding here is, remember, we're trying to play the correct direction in the market. The correct direction is going to be shown to us by previous highs or previous lows being taken, and that's what we're trying to identify over time. Remember that the intention in the market, what they're going to want to do is move price in their direction. And remember, what's the observation of that? That's a trending market, essentially, right? Remember, we can move slow, we can move fast, but over time, price is going to go in their direction. We can see here, this mitigation, we'll be looking for continuation. We know that phase of continuation, we can maximize our profit potential, and then we'll obviously look for previous lows in the market as targets for that continuation. Again, using a fixed process. Yes, you can trade into previous lows. Obviously, previous lows certain times will be less than 10R, but for me, I know that I can average this return over time, and this is what is favorable to me. So another nice day. Let's move on to the last trade now. Let's think about what we're doing here, guys. We're using a repeatable process to become aware of the phases of the market. We can understand that in various phases of the market, there's going to be presented to us high probability positions and low probability positions. What we need to do is, as a trader, understand over time where we're located and the types of trades that we're taking. Most of the time when we take these style of trades, you maybe don't know why you're taking them, but most of the time they're following intentions shown in the market. Start to realize that. Is that what you're doing? Because sometimes when you do that and you take trades and they end up being low in price, we can start to get losses. And so many times I see traders trading at the end of the move, trading in these sorts of locations to go lower, anticipating that this is going to be a massive move, when all that happens next is price pulls back. So as professional traders, we need to know how to locate ourselves in the market and be able to present ourselves in higher probability opportunities as often as possible during our trade hours. Remember, we're only focusing on 8 till 10 o'clock, 2-hour sessions, 4 days a week. So we can see here, coming into the market, we can quite easily identify initiation in the market. We can see here prices initiating to the upside, and then we start to see price slow down. We start to see price take a previous low, take a previous high, and then pull back in the opposite direction. So as much as I can see that bullish initiation, I can also see new intentions enter the market. And this intention is for lower prices. We can see that because when price starts to pull back into that 50% location, prices respecting, ranging, and initiating into lower prices. Now we can see here that price, when it was moving higher, we can clearly identify that it's slowing down. It slows down here, slows down here, and then over time slows down here. We can see that this is equal to a range, and we see that we have range initiation in the opposite direction. So that's an observation that we can utilize to find the correct direction in the market. And let's go up to a higher time frame real quick. Let's utilize the understanding of what we're doing here, and we can see that overall from a high to a low, that prices pull back into a previous range. What do we see? We see that prices run above previous liquidity in the market and moved into a point of mitigation. We can see here previous range in the market where we can have a narrative for a mitigation and to play the continuation of that intention. If I just zoom out even more here, we can start to see that the location of the session is presented over time in the middle of delivery. We can see here this is a lot of consolidation being shown to us, a lot of sideways delivery, and we know that when we do get that started delivery, we can anticipate that next initiation in the markets. Now, the purpose for direction is important because rather than trading in these poor locations with no understanding, what we can start to do is trade in these directions with a bias. And what do we see here? We see no pullback to a point of mitigation. We see price pulling back to relatively 50% and continuing. We see that once again, price pulling back to this location and continuing. So the narrative is being shown to us. Remember what price has done is pull back above a previous high. So we can definitely start to see the continuation of that intention into that previous low following that delivery in that market. I'm just going to quickly jump up to the 5-minute time frame here because I do want you to understand the delivery that we're involved in here. We can see that from a higher time frame perspective, we've had a sideways delivery that is initiated into a bearish market. So what was we doing before that? We can see that price is continuing to push higher from low prices, continue to push higher. I'd assume that this location is equal to some sort of mitigation to the left, and that would be why I'll be looking to anticipate price to move lower. And we can see that over the week, we have been presented that information. And then when we approach today, we can see that we're inside the middle of this range. Now, I know so many people that use liquidity as concepts, as these things that drive the market, when that's just not true, right? Because liquidity is shown in direction, not just from running previous highs and previous lows, but what it creates. And when we look to play poor location, seeing runs of liquidity in the middle of the range is a good way to find a bias for a reversal following a higher time frame direction. So we can see here, this is how we're deriving that understanding. We can also see the location here of the mitigation is equal to high premium prices based on this sideways range, this contained delivery that we have. So to sell here would be to sell in premium, and this is how we can start to utilize logic for our executions. It's not just liquidity. Remember, this is a mitigation. So we're not just looking at liquidity here, we're also looking at previous ranges in the market where we can see points of mitigation, where we can see continuation. We've seen it once before from this location. We now see a run above a previous high into that point. So again, a nice high probability position of observing the previous high being taken. So what can we see here? We can see that, just hop down back to the 1 minute. We can see that price is moving slow at this point of mitigation. So remember, that's an observation, and we was bullish into it. That bullish price delivery slowed down, and then we start to sort a new intention in the market moving in the opposite direction. And we can identify that because price is not pulling back into its edge, and we can see that price based on this A to B is pulling back into that 50% location. So this is actually where I took my first position to get short, back at this point of mitigation here with a stop above its high and looking for price to move in the bearish direction. Had around a 2.8 pip stop, 2.5 pip stop, and this is the position I was essentially looking to play. I got in, I was part of that range essentially, got taken out for SL just as price then moved in that range initiation direction. So obviously unfortunate, this happens. I win, lose and break even, just part of the process. But it is good to see that I have the right direction in mind because we do see range initiation in that direction. And that's what led me to become an observer of the next phase of the market, because this is what we want to identify. We use range initiation, mitigation, continuation to identify those phases. I want to be in on those points of mitigation because they create initiation, continuation in price. Continuation obviously aims below the previous low, and that can lead to extension in the move, and it's where my big RR comes from, right? What I'm not looking to do is trade the sideways delivery where price isn't extending in any direction, even though that does happen at times, right? I'm trying to manage and maintain myself in those sideways deliveries. So here we can see clear range initiation to the downside, price pulls back, taps it, and then we start to move in opposite direction. We can see here now, this overall location is equal to 50%. We can see here, even just based on our previous bullish move, if we're still tracking that bullish move, we can see where our entry is in and around that 50%. And we also know based on a higher time frame, if we can see here that our trade is also in and around 50%. We're not trading up here close to edge and close to high premium. We're trading more closer to that 50% location. So knowing the probability of my trade, I really understand what I'm doing here. Being able to identify initiation in the market is really what's allowing me to, even though we are in a low probability location, is play that direction in mind. So this is the execution I want to go over today, and we can see the point of mitigation, price coming into that previous point of mitigation. There is a inside bar right here, which is equal to a range, and I saw price react from that location. I personally couldn't be involved in this because I never had a safe stop location to play. If I did have a safe stop, it would have had to been up here, and I wasn't essentially prepared to enter with such a large stop. When price moved away and came back up, essentially this is what I was doing, playing a continuation of that intention. There was a variation of entry here. Again, we just went over liquidity can be a great observation of new intention in the market. And we see here that previous high was run, that was created in the market, and then price moves into the edge here, which is equal to a point of mitigation, allowing me to have a safe stop above the previous high. Notice that Previously, I couldn't have that safe stop. We're now in with a 3.4 pip stop, looking for price to move in the bearish direction. My entry was just a slightly better because my broker high was slightly lower. It's about 2.8 pip stop. And I was looking for price to move in that continuation location. So let's just play this forward. You can see price then runs in that bearish direction, taking out those previous lows, allowing us to see that we're a part of the correct direction. So remember, guys, going from range to initiation. That's exactly what I want to see as I start to enter my trade. Notice that it's not taking very long for price to show itself. Again, these are all great signs of being in the correct intention. And then it was waiting for our fixed process of that 10-hour trade to be presented to us and allow us to play the continuation of price overall. Now, knowing that this is the middle of the range, seeing that price is sideways over time, yes, I have that bearish intention, but this location overall isn't the best positioning for my trade. It is clearly at 50%, but in my session, I've followed the intention shown, and that's what I've been able to do. I can also not take the trade because it is based on low probability because of the location, but playing the intention shown is exactly what I was doing there. Like I said, I was in that first trade and this was the follow-up, right? So nice trade to be playing. Watching the continuation of this trade, what can we see? We can see price moving back into point of mitigations, reacting, and essentially continuing to move sideways. We can see the higher time frame move here, really showing ourselves to be sideways. We come back into our previous low and then we start to react in the bullish direction, and essentially I get taken out for break even on this trade. Unfortunate, but I want to show you this, guys, because this is a reality of trading. This is how price presents to us. I win, lose, and break even. I win in variations, I lose in variations, and I break even in variations, but they all equal to the same thing. So this is just a part of the process. I know based on discipline, based on people's psychology, that this might not be enough for them. They might say, hey, but why don't you just take a trade out here? Or why don't you just close out here? But this is the whole point of having a fixed process. I have data backed over 4 years, knowing that I can aim for 10 hours on a consistent basis in my session, always playing the most high probability trades, putting myself in the correct direction over time. Now, I just went over 4 trades that hit full TP. This one was a break even, really not bothered. It's just part of the process, just part of the series, and I can move on with my session. I think it was a great opportunity to be involved in. And as we see over time, price ends up moving in that bearish direction. So nice to play that lower price delivery into that higher time frame direction, where we did see the previous low get taken and we did see the previous structure here get run. Throughout this journey at NGAT, we've seen that the elite traders differentiate themselves not through luck, but through a structured approach to understanding the market intentions. As we demonstrate daily, consistent profitability comes from what price is actually showing us and following it. Success begins at discipline, first identifying the range initiation before considering any executions. This repeatable approach aligns your trading decisions with the correct direction in price rather than the daily emotions or guesswork. By observing the narrative that price is telling us and focusing on the structure it's presenting, you can remove the inconsistencies that plague discretionary trading. The market is continuously showing us its intention, and your job isn't to predict, but to simply listen and respond accordingly. That's the job of a professional trader.